Hi, I'm Jim Jubak, and welcome to my YouTube video for Wednesday, January 25th. I'm wearing my daughter's Bodega Cats t-shirt again, dropping on February 18th, for those who stream music and want to be on the cutting edge. Lunoctium is her songwriting name, song-singing name, performing name. Okay, anyway, if you like this video, please give us a thumbs up. Subscribe to my YouTube channel, because that way you get notification when we're doing the next one. We're doing about 3 a week, but not always on the same day. If you want more of my stuff, including usually about 1 or 2 posts a day and 3 portfolios, you go to my free site, that's jubakpicks.com, or even more portfolios, 6 instead of 3, with some options and ETFs and really long-term stuff. You can go to my paid site, that's jubakam.com, and you find links to all that down below. Okay, today's topic. Don't pay for the illusion of control. The market is rallying because it's fixated on the Fed's move on the 1st of February, probably to reduce its interest rate increase to 25 basis points after reducing it to 50 basis points in December. Theory is that this is all part of a move to the Fed pausing and then perhaps sometime in 2023 or 2024 actually starting to cut interest rates. The thing that concerns me here is not just the fact that this is priced in as 100% likely at this point, which raises the possibility that if the market is disappointed and the Fed actually raises by 50, it can be a huge move. But that there's the assumption here that if the Fed does this, XYZ will follow, because after all, we know the Fed is in control. Well, you know what I gotta say to you is horse pucky. The Fed is not in control. No one is in control of this economy right now. There are just too many loose ends, and there always are. The idea that the Fed will do a rate move and these things will result from that assumes that, well, there are no lags in the system, there are not other things going on. So that right now, for example, the Fed has been trying to reduce its balance sheet by letting $95 billion a month in treasuries and mortgage-backed securities sort of mature out of the portfolio and not replacing it. Well, that's great. That also never took account of the fact that we're looking like we're headed toward a debt ceiling crisis. How do these two things play together? You're reducing the supply of treasuries from the Fed at the same time as you're reducing the supply of treasuries from the Treasury, since the Treasury is not issuing anymore because it can't because of the debt ceiling. So all kinds of money is sloshing around in the financial system right now. Banks are doing this with reserves. You got money market funds looking for bonds to buy and not finding any. So uncertainty there, what's going to happen. Add to that, we've got China. No one knows what's going to happen in the Chinese economy because of this huge outbreak of COVID. Maybe as many as 1 million deaths in China. Economy will go down the toilet, but Beijing will pour money into the system, so we don't know what will happen. Japan is seeing a huge upsurge in inflation, strangely enough. I mean, we're still talking about 3%, 4%, maybe not 7%. Like here, but this is unusual in Japan. The Bank of Japan has so far refused to move on interest rates, keeping them at 0 or a little below 0. How long that will continue is open to question. Bank of Japan says, no worry, we're seeing oil prices come down. Hey, yeah, right, we can guarantee that. We're looking at the possibility of a U.S. recession. We've got the debt ceiling battle, and sometime this spring we'll see a big upsurge in fighting in Ukraine as Russia goes on the offensive again and attempts to reverse momentum. All these things mean, hey, I would certainly think about whether I wanted to pay for certainty that's not really certainty. There's a sort of certainty premium, if you will, in the market. Look at what banks did in their last earnings. This is a couple of weeks ago. It's not so much that the banks said, hey, there might be a recession, but that they started to put some money into reserves just in case. It's just in case. It's the idea of hedging so that if things go against you, it's not you don't have all your eggs in that basket. So I'd think about that. That determines how much you want to pay for stocks in this market. I would be cautious right here. Thanks for watching. If you like this video, please give us a thumbs up. Subscribe to my YouTube channel. That way you get notification when we do the next one. We're doing about 3 a week. To get more of my stuff, you can go to my free site. That's jubakpicks.com. 3 portfolios there, or jubakam.com site, which is the paid site, and that has 6 portfolios, including some ETFs and options. Thanks very much for watching.